Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hey everybody, today is October 6, 2025. Welcome to the Northbound Wealth Podcast, Weekly Market Insights. Let's dive in and review last week and talk about what's going on this week. Stocks advanced despite DC shutdown. So stocks rose last week looking past the government shutdown and apparently discounting any impact it may have on the economy. The S&P 500 moved up 1.08% last week to its highest close ever, boosted by strong gains in healthcare sector amid an agreement between Pfizer and the Trump administration. The S&P 500 ended Friday's session at 6,715.79 and now is up around 14% for the year. It also reached an intraday high on Friday at 6,750.87. On Tuesday, the market benchmark ended September with a 3.5% gain, its fifth consecutive monthly increase. The index rose 7.8% in the third quarter of 2025. The NASDAQ Composite Index, which is the tech-heavy index, rose 1.32% last week. The Dow Jones Industrial Average advanced 1.10%. The MSCI EFA Index, which tracks developed overseas stocks, gained around 2.53%. Let's review last week's market action. The S&P 500 and NASDAQ rose out of the gate Monday morning despite the threat of a possible government shutdown. Everybody's heard about it. It was hanging over investor sentiment. As the midnight deadline approached for Congress to pass a continuing resolution that would temporarily fund the federal government, the prospect of a shutdown dominated market sentiment. The White House discussed permanent layoffs of some federal workers, stoking fears of further slowing an already sluggish labor market. Stocks initially fell on the news of the government shutdown, but recovered by midday, driven by growing investor expectations that the shutdown would be short-lived. The S&P closed above 6,700 for the first time, as I mentioned, and momentum tempered after Treasury Secretary Scott Bessent suggested that GDP, or gross domestic product, may take a hit due to the shutdown, but all three averages recovered and closed at record highs. Stocks were mixed on Friday after the Senate failed to pass dueling funding bills that would have prevented the shutdown from entering its second week. So the markets see through the political noise and broaden out. So the market started the final quarter of 2025. So we're in the start of the fourth quarter with healthcare stocks rallying after President Donald Trump and said Pfizer agreed to provide some of its most popular medications at highly discounted prices. The agreement was seen as lifting a cloud of uncertainty that had been hanging over the sector and is expected to be followed by deals with other drug makers. The healthcare sector logged a 6.8% gain for the week, followed by a 2.4% increase in utilities and a nearly 2.3% rise in technology. Industrials, materials, and real estate also edged higher. Pfizer's shares climbed 15% on the week amid its deal with Trump. Other strong gainers in the healthcare sector included shares of biotech up 21%, Charles River Laboratories up 19%, and Thermo Fisher Scientific are up around 17%. In the utilities sector, shares of Constellation Energy rose 8.7% as the company reached a $340 million agreement with the state of Maryland to fund environmental projects and operational improvements in the Conowingo Dam area. The deal will allow the relicensing and continued operation of the hydroelectric facility on the Susquehanna River. On the downside, energy fell 3.4%, followed by a 2.1% drop in communication services and a 0.8% decline in consumer discretionary. Consumer staples and financials also edged lower. The energy sector's drop came as crude oil futures also fell on a weekly basis. Stock decliners in the sector included Valero, which fell 8.7%. The stock received an investment rating downgrade from Morgan Stanley to equal weight from overweight, even as the firm raised its price target on the stock to $175 per share from $160 per share. And equal weight exchange traded funds, or ETFs, ticker symbol EDOW and RSP, which represent the Dow Jones Industrial Average Equal Weight Index and the Equal Weight Index of the S&P 500, both hit all-time highs last week. And what I want to share with you is this means that markets continue to broaden out by the bull market, and the bull market story isn't just about the Mag 7. So take a look at those particular exchanges and ETFs and indexes. You'll see the market's actually broadening out, and that's a good sign for the health of the market. Okay. So weekly market insights, major index return summary. Year to date, NASDAQ Composites up 18.89%, S&P's up 15.30%, Dow Jones is up 10.76%, and MSCI is up 26.69%. 10-year Treasury notes trading around 4.13%, and that is down from the 3 months ago is at 4.35%. So that's a 5% decline. And it's interesting to see that yields are backing up, meaning what that means, I guess, is declining on the 10-year note. So hopefully that will help out the 30-year mortgage rate. I sure hope that does. So we'll kind of get into that later. But thank you, Y-Charts, for that information. The jobs report's delayed, and that has to do with the government shutdown and its potential impact on different bureaus reporting statistics. So one of the first impacts felt was the Bureau of Labor Statistics monthly employment report, scheduled for release last Friday, but delayed until the government reopens for business. And however, ADP's monthly report released Wednesday last week showed that corporate employers shed 32,000 jobs in September, below the forecast of 45,000 new jobs. So that's a pretty big discrepancy, but we'll see how when the government reopens what the data looks like in lag. Okay, this week, key economic data. Let's see. Tuesday, trade deficit, goods and services. So we're looking at consumer credit, how the consumer's doing. Fed speeches. There's a plethora of Fed heads going to be talking this week. I'm not going to name them all. Wednesday, we'll continue. I'm going to see what Neil Kashkari says. I'm curious about his comments. Let's see. September FOMC meeting minutes and the 10-year Treasury note auction happens Wednesday. Thursday, more Fed heads. It's like the Fed All-Star Week here. I'm just tired of all of them, frankly. We talk about them way too much. Wholesale inventories, Fed balance sheet. Friday, consumer sentiment, federal budget, and then another final speech by one of the Fed heads. I think this is like job interview season for them. Notable companies reporting earnings. Let's see, Pepsi, Delta, Constellation Brands, and McCormick. So we'll be following that. Tax tip of the week. So what is the premium tax credit? The premium tax credit is a refundable credit that helps eligible individuals and families cover the premiums for their health insurance purchased through the health insurance marketplace. There are a few requirements to qualify for the PTC, including having a household income with specific range. So if you or your spouse received unemployment compensation for any week beginning in 2021, so you kind of have to dig through the archives on that one, your household income may fall within the range. So you have to look that range up. Not filing a tax return using the filing status, married filing separately. So you can't do that. So not being claimed as a dependent by another person. Have health insurance through the health insurance marketplace. Are not able to get affordable coverage through an eligible employer-sponsored plan that provides minimum value, and do not qualify for coverage through a government program. So talk to your individualized tax professional. This information is not a substitute for individualized tax advice. Please consult a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. And I will mention this is the season. Fall is seemingly turning, like it's here finally, and it's a chilly month, right? So a lot of chili contests going on, and the white bean chili recipe. If you want to check that out, check it out on blog. I have it posted out there, and you got to break out that Dutch oven, man. It's going to be great. All right, stay tuned for the next segment. We've got a great show for you. A lot of information this time around. It's been a little bit since I've released a podcast, and we'll have some fun. All right, thanks for listening. Are pennies going away? Meaning the currency, penny with Abraham Lincoln on it. I typed this into AI just to get the overview because people are talking about it. And the answer is no, pennies will not be phased out in 2025. The U.S. Treasury Department is expected to stop producing new pennies in early 2026 after the last order of penny blanks runs out. Pennies currently in circulation will remain legal tender indefinitely, similar to how Canada continues to use pennies even after discontinuing production. Why the penny is going away? Well, it costs more than 3.5 cents to mint and distribute each 1 cent penny, making it a money-losing endeavor. The increasing prevalence of electronic payments has led to fewer pennies being used in daily transactions, the Federal Reserve Bank of Richmond explains. Budgetary savings is another reason why. Phasing out the penny is seen as a way to reduce waste and save taxpayer money, with one report estimating annual savings of $56 million. What happens next? So the production ends. The U.S. Mint will finish its final order of penny blanks in early 2026, which should be sufficient to produce the last new pennies. Rounded prices. Cash transactions are expected to be rounded to the nearest nickel, though the specific rounding policies will be up to individual retailers. So keep that in mind when you go to pay. All right. Pennies remain legal tender. They'll continue to be legal tender as long as they are in circulation, but they will not be replaced as they wear out. So, are pennies going away? It's the beginning of the end of the penny. That's my opinion. Thought you should know since this is a financial podcast. Have fun saving those pennies and rounding out those penny collections. So as you've likely seen, the federal government shut down as of October 1st, 2025. These episodes are frustrating and disruptive, but they're not new. History gives us a helpful perspective. Below are the key points we here at Northbound Wealth want you to know. Number one, Social Security benefits near term and longer term. Payments will continue. Social Security is mandatory spending, not part of the annual appropriations that shut down. The SSA follows a contingency plan that keeps benefits flowing even when parts of the government close. Some in-office services can slow or pause, but checks direct deposited to you continue. Longer-term solvency is a separate issue. So a shutdown doesn't change the underlying Social Security trust fund math. That's a legislative actuarial problem, not a shutdown problem. Expect normal benefits now. Any long-run changes, if Congress eventually enacts them, would come through separate legislation, not via a shutdown. Number two, what past shutdowns did to the stock market. So historically, stocks moved during shutdowns are modest and often positive. Looking across shutdowns since the 1970s, the S&P 500 is roughly flat on average during the shutdown window, with a slight tendency to rise rather than fall. In 2023, in 2013, 16-day shutdown, the S&P 500 dipped about 2 to 3% at one point, but finished the period up. During the 2018 to 2019 shutdown, that was 35 days, the S&P 500 actually rose 10% over the span. Past results don't guarantee future outcomes, so this time, I guess, could be different, but so far it doesn't look like it. Recoveries tend to be quick. Across shutdowns, the index has been higher a majority of the time, 1 to 12 months later, with one study showing the S&P 500 was higher 86% of the time a year later, averaging 12 to 13%. Remember, past results don't guarantee future outcomes. Number 3, after the recovery, then what? So, in cases where stocks fell during the shutdown and then recovered, markets often kept climbing alongside the broader economic and earnings backdrop. The 2013 and 2018 to 2019 episodes are good examples. After short term volatility, indices moved to higher levels over the following months as investors refocused on fundamentals, interest rate policy, and earnings. The same dynamic, policy noise versus business results, tends to dominate once the headlines fade. How we're positioned. So, our job is to separate the signal from the noise. Shutdowns can delay data releases and create short term volatility, but they have not historically been a reason to rethink a long term strategy. If this stretches on and new facts change the outlook, we might need to review our outlook. If you have any questions, give us a call. Northbound Wealth Management, 317-399-1107. Stay tuned for the next segment. All right, private health insurers use AI or artificial intelligence to approve or deny care. Soon, Medicare will too. This is an article by Lauren Saucer and Darius Tahir of KFF Health News, and it was posted on CNBC and NBC News. So I thought I would share this because I find it interesting. This was published on September 24th, 2025. So let's dive in. So, taking a page from the private insurance industry playbook, the Trump administration will launch a program next year to find out how much money an artificial intelligence algorithm could save the federal government by denying care to Medicare patients. A pilot program designed to weed out wasteful, low-value services amounts to a federal expansion of an unpopular process called prior authorization, which requires patients or someone on their medical team to seek insurance approval before proceeding with certain procedures, tests, and prescriptions. It will affect Medicare patients and the doctors and hospitals who care for them in Arizona, Ohio, Oklahoma, New Jersey, Texas, and Washington, starting January 1st, 2026, and running through 2031. The move has raised eyebrows among politicians and policy experts. The traditional version of Medicare, which covers adults 65 and older and some people with disabilities, has mostly eschewed prior authorization. Still, it is widely used by private insurers, especially in the Medicare Advantage market. And the timing was surprising. The pilot was announced in late June, just days after the Trump administration unveiled a voluntary effort by private health insurers to revamp and reduce their own use of prior authorization, which causes care to be significantly delayed, said Dr. Oz, administrator of the Center for Medicare and Medicaid Services. It erodes public trust in the healthcare system, Oz told the media. It's something that we can't tolerate in this administration. But some critics like Dr. Vinay Rathi, an Ohio State University doctor and policy researcher, have accused the Trump administration of sending mixed messages. On one hand, the federal government wants to borrow cost-cutting measures used by private insurance, he said. On the other hand, it slaps them on the wrist. So administration officials are talking out of both sides of their mouth, said Representative Susan DelBene, a Washington Democrat. It's hugely concerning. Patients, doctors, and other lawmakers have also been critical of what they see as delay or deny tactics, which can slow down or block access to care, causing irreparable harm and even death. Insurance companies have put it in their mantra that they'll take patients' money and then do their damnedest to deny giving it to them, to the people who deliver care, said Representative Greg Murphy, a North Carolina Republican and a urologist. That goes on in every insurance company boardroom. Insurers have long argued that prior auth reduces fraud and wasteful spending, as well as prevents potential harm. Public displeasure with insurance denials dominated the news in December, when the shooting death of United Healthcare's CEO led many to anoint his alleged killer a folk hero. By the way, I cannot believe that people would even do that. Celebrating someone's killing. It's just inhumane and scary, actually. And the public broadly dislikes the practice. Nearly 3/4 of respondents thought prior auth was a major problem in a July poll published by KFF. a health information nonprofit that includes KFF Health News, which I am reading from, which I am sharing this article from. Indeed, Dr. Oz said during his June press conference that violence in the streets prompted the Trump administration to take on the issue of prior auth reform in the private insurance industry. Still, the administration is expanding the use of prior auth in Medicare. CMS spokesperson Alex Pons said both initiatives serve the same goal of protecting patients and Medicare dollars. So the unanswered questions, it's the pilot program, WISER, short for Wasteful and Inappropriate Service Reduction, will test the use of an AI algo, in making prior auth decisions for some Medicare services, including skin and tissue substitutes, electrical nerve stimulator implants, and knee arthroscopy. So those are those areas. The federal government says such procedures are particularly vulnerable to fraud, waste, and abuse, and could be held in check by prior authorization. Other procedures may be added to the list, but services that are inpatient only, emergency, or would pose a substantial risk to patients if significantly delayed would not be subject to the AI model's assessment, according to the federal announcement. While the use of AI in health insurance isn't new, Medicare has been slow to adopt the private sector tools. Medicare has historically used prior auth in a limited way with contractors who aren't incentivized to deny services, but experts who have studied the plan believe the federal pilot could change that. So Pons told KFF Health News that no Medicare request will be denied before being reviewed by qualified human clinician, and that vendors are prohibited from compensation arrangements tied to denial rates. While the government says vendors will be rewarded for savings, Pons said multiple safeguards will, quote, remove any incentive to deny medically appropriate care. Shared savings arrangements means that vendors financially benefit when less care is delivered, a structure that can create a powerful incentive for companies to deny medically necessary care, said Jennifer Brackeen, Senior Director of Government Affairs for the Washington State Hospital Association. And doctors and policy experts say there are only one concern. Rothi said the plan is, quote, not fully fleshed out and relies on messy and subjective measures. The model, he said, ultimately depends on contractors to assess their own results, a choice that makes results potentially suspect. I'm not sure that they even know, I'm not sure they know even how they're going to figure out whether it's helping or hurting patients, he said. Pons said the use of AI in the Medicare pilot will be subject to strict oversight to ensure transparency, accountability, and alignment with Medicare rules and patient protection. CMS remains committed to ensuring that automated tools support, not replace, clinically sound decision-making, he said. Experts agree that AI is theoretically capable of expediting what has been a cumbersome process marked by delays and denials that can harm patients' health. Health insurers have argued that AI eliminates human error and bias and will save the healthcare system money. These companies all have also insisted that humans, not computers, are ultimately reviewing coverage decisions, but some scholars are doubtful that's routinely happening. Let's see. I think there's also probably a little more ambiguity over what constitutes meaningful human review, said Amy Kilalia, an assistant research professor at the Center of Health Insurance Reforms at Georgetown University. A 2023 report published by ProPublica found that over a 2-month period, doctors at Cigna, who reviewed requests for payment, spent an average of only 1.2 seconds on each case. Cigna spokesperson Justine Sessions told KFF Health News that the company does not use AI to deny care or claims. The ProPublica investigation referenced a simple software-driven process that helped accelerate payments to clinicians for commonly relatively low-cost tests and treatments and is not powered by AI, Sessions said. It was not used for prior authorizations. And yet, class action lawsuits filed against major health insurers have alleged that flawed AI models undermine doctor recommendations, and failed to take patients' unique needs into account, forcing some people to shoulder the financial burden of their care. Meanwhile, a survey of physicians published by the American Medical Association in February found that 61% think AI is increasing prior authorization denials, exacerbating avoidable patient harms, and escalating unnecessary waste now and into the future. Chris Bond, a spokesperson for the insurer's trade group AHIP, told KFF Health News that the organization is zeroed in on implementing the commitments made to the government. Those include reducing the scope of prior auth and making sure that communications with patients about denials and appeals are easy to understand. This is a pilot, so the Medicare pilot program underscores ongoing concerns about prior auth and raises new ones, while private health insurers have been opaque about how they use AI and to the extent to which they use prior authorizations. Policy researchers believe that these algorithms are often programmed to automatically deny high-cost care. The more expensive it is, the more likely it is to be denied, said Jennifer Oliva, a professor at the Maurer School of Law at Indiana University Bloomington, whose work focuses on AI regulation and healthcare coverage. Oliva explained in a recent paper for the Indiana Law Journal that when a patient is expected to die within a few years, health insurers are, quote, motivated to rely on the algorithm, end quote, as time passes and the patient or their provider is forced to appeal a denial. The chance of the patient dying during the process increases. The longer an appeal, the less likely the health insurer is to pay the claim, Oliva said. The number one thing is to make it very, very difficult for people to get high cost services, she said. As the use of AI by health insurers is poised to grow, insurance company algorithms amount to a regulatory blind spot and demand more scrutiny, said Carmel Shakar, a faculty director at Harvard Law School's Center for Health Law and Policy Innovation. The WISER pilot is an interesting step toward using AI to ensure that Medicare dollars are purchasing high-quality health care, she said, but the lack of details make it difficult to determine whether it will work. Politicians are grappling with some of these same questions. How is this being tested in the first place? How are you going to make sure that it is working and not denying care or producing higher rates of care denial? Asked Del Bene, who signed an August letter to Oz with other Democrats demanding answers about the AI program, but Democrats aren't the only ones worried. Murphy, who co-chairs the House GOP Doctors Caucus, acknowledged that many physicians are concerned the WISER pilot would overreach into their practice of medicine if the AI algorithm denies doctor-recommended care. Meanwhile, House members of both parties recently supported a measure proposed by Representative Louis Frankel, a Florida Democrat, to block funding for the pilot in the fiscal 2026 budget of the Department of Health and Human Services. AI in healthcare is here to stay, Murphy said, but it remains to be seen whether the WISER pilot will save Medicare money or contribute to the problems already posed by prior authorization. And this is a pilot, and I'm open to seeing what will happen with this, Murphy said, but I will always err on the side that doctors know what is best for their patients. So, financially, you guys, as the AI revolution continues and the use cases are applied throughout basically every aspect of our lives, healthcare and claims, denial or approval is no different. So we'll keep tracking this particular study and subject and topic because it does impact your finances. And that's why I thought it was relevant, because we probably need to focus more on self-funding, like using HSAs and saving money for those potential situations where you might be denied care due to the algorithm, and then the approval process might take time. So you might be more responsible going forward about your health care from a financial perspective. So this is an important subject. I hope that it actually saves Medicare money, and maybe it'll improve the cost burden. I mean, hopefully it's a tool that can be used. If it can be used in many other applications, hopefully it can be used here. So save money and the cost of care will decline, not continue to have an inflation rate of 7% to 8% per year. All right, on to the next segment. So I came across this article on October 2nd. It was published, and the headline is FICO provider is shaking up its credit score business. Its stock is surging. And this is by Pia Singh, CNBC. Key points. Fair Isaac on Wednesday unveiled a new pricing model that will allow mortgage lenders to bypass credit bureaus for credit scores, leading the company's shares to pop more than 20% on Thursday. The company will license its FICO credit scores directly to mortgage resellers who can then distribute the scores directly to borrowers. Shares of Experian, TransUnion, and Equifax fell as investors saw the chance for Fair Isaac's announcement to lessen the role of credit reporting agencies. Fair Isaac, the creator of the FICO score, saw shares rally more than 20% on Thursday after it unveiled a new pricing model. The Montana-based data analytics company, Fair Isaac, said it would license its credit scores directly to mortgage resellers who can then distribute FICO scores directly to borrowers. The score is used by nearly 90% of lenders to evaluate a borrower's credit risk. FICO scores generally range from 300 to 850, with higher scores reflecting lower credit risk. The pop in Fair Isaac stock is the largest percent increase since November 22nd. The shares are down about 9% this year. Under the new plan, lenders will have the option of choosing between two pricing models. This change eliminates unnecessary markups on FICO score and puts pricing model choice in the hands of those who use FICO scores to drive mortgage decisions, Fair Isaac CEO Will Lansing said in the release. So shares of credit bureaus Experian, TransUnion, and Equifax fell between 4% and 10% each, as investors saw Fair Isaac's announcement as possibly lessening the importance of their businesses. Fair Isaac plans to offer both of its mortgage score pricing models to 3 credit bureaus on the same terms. And so it's very interesting. You got Bill Pulte, Federal Housing Finance Agency director, said in a Thursday morning X post that Fair Isaac's moves marks an effort to, quote, generate creative solutions to help the American consumer, end quote. Pulte, who in late July had criticized Fair Isaac as a, quote, monopoly, end quote, with unfair credit score price hikes, added, I encourage the credit bureaus to also take similar creative and constructive actions to make our markets safer, stronger, and more competitive. So that's a big change, especially when we're faced with a massive refinancing boom in the next year or two as interest rates come down. Thought that would be interesting to share with you guys. Stay tuned for the next segment. So I went out and I saw news about EA Sports. Those of you who play video games and things like that, it's a big deal. So EA Sports, or EA, announces agreement to be acquired by PIF, Silver Lake, and Affinity Partners for $55 billion. So according to their website and news release from EA, this was on September 29, 2025. This accelerates EA's strategic vision to advance the future of entertainment. Stockholders to receive $210 per share in cash, representing a 25% premium to unaffected share price. The transaction represents the largest all-cash sponsor take-private investment in history. So Redwood City, California, on the Business Wire's Electronic Arts, or EA, global leader in interactive entertainment, today announced that it entered into a definitive agreement to be acquired by an investment consortium comprised of PIF, Silver Lake, and Affinity Partners. An all-cash transaction that values EA at an enterprise value of approximately $55 billion. The transaction positions EA to accelerate innovation and growth to build the future of entertainment. It's crazy. It's a huge deal. I think that it's going to change the game for EA on the reporting front, especially, but also on some of the things that maybe they can do. So this consortium, Saudi Arabia's Public Investment Fund, which is PIF, held a 9.9% stake in EA before the deal, the largest insider stake, and will roll over that investment with intentions to scale. PIF owns Savvy Gaming Group and has purchased companies such as EASL, Faceit, and Scopely. Silver Lake Partners, a private equity firm focused on technology and media investments. Silver Lake is also part of the new Oracle-led joint venture set to take on management of TikTok's U.S. operations. Affinity Partners, led by Jared Kushner, President Donald Trump's son-in-law. The firm is a participant in the buyout. The transaction requires shareholder approval and review by the Committee on Foreign Investment in the U.S., as CFIUS, due to Saudi involvement, per the AP News. So they'll evaluate the transaction for potential national security and foreign ownership considerations. The deal is expected to close in the first quarter of fiscal 2027, if approved. So, why EA was targeted for acquisition? This came from a Yahoo Finance article. Founded in 1982, according to its website, EA became one of the most influential video game publishers worldwide. Its catalog include sports titles such as Madden NFL, FIFA, EA Sports FC, first-person shooters like Battlefield, life simulation games such as The Sims, life service titles including Apex Legends. According to the AP News, annual revenues have remained steady, ranging from $7.4 billion to $7.6 billion over the past fiscal 3 years. The buyout offers a path for the company to operate outside the reporting requirements of public markets. So analysts have also pointed to upcoming titles such as Battlefield 6 as part of EA's future value. What it means for the gaming industry. So industry consolidation has been notable in recent years. In October of 2023, Microsoft acquired Activision Blizzard for $69 billion. As previously reported, Microsoft subsequently reduced its gaming division workforce by approximately 1,900 employees. With EA going private, the number of large independent game publishers will continue to decline, which may impact competition and partnerships across the industry. EA's headquarters will remain in Redwood City, California, and CEO Andrew Wilson will continue to lead the company, per AP News. The outlet also states that its major franchises are expected to remain central to its portfolio. Financing details indicate the transaction involves about $20 billion in debt, backed by JP Morgan Chase, Bloomberg reports. Looking ahead, who bought EA could shape its future. So, if the deal closes as expected, it will mark the end of EA's 36-year run as a publicly traded company. AP News reports, so EA's first day of trading closed at 52 cents per share after a stock split, compared to the $210 per share buyout price. The company went public 7 years after its founding. The agreement highlights continued investment activity in the growing gaming sector, particularly from sovereign wealth funds and private equity, signaling that the investors who bought EA may influence the industry's next phase. So we're going to follow this. There has been as an aside or an observation in the public marketplace, I forget the exact date, but a decade or two ago, there were 8,000, maybe even longer, maybe 3 decades ago, there was 8,000 publicly traded stocks listed on exchanges out there. Now they're around 3,000. So there are more and more companies staying private longer, or being taken private. And that actually, for the public markets, forces, I think it's just an interesting behavior that's happening. If more and more companies are staying private, a lot of the money is being made in private markets. And that limits access to the broader population to invest in individual equities. So I'm just curious about this, and I'll probably be investigating this or looking at this more as to how it's going to affect equity valuation, stock picking, and having access to some of the best companies that are generating great ideas, future cash flows, and returning dividends and stock buybacks and price appreciation for investors in the public markets. Or are we just going to eventually have few stocks to trade and invest in, that all we have access to are exchange traded funds or ETFs that own the underlying holdings? So it basically limits the retail access to individual equities, and it forces institutional ownership to do most of the buying and selling and trading. Of late, of the last few years, the retail investor has gotten the best of some of the institutional traders, starting with GameStop, AMD, and some of the shorts targeting the heavily shorted stocks in buying. And so I'll be interested to see how this goes, and I'll communicate that going out. So mortgage rates are expected to move below 6% by the end of 2026. This was an article by Fannie Mae, published on September 23rd. Mortgage rates are forecasted in 2025 and 2026 at about 6.4% and 5.9%, respectively, according to the September 2025 Economic and Housing Outlook from Fannie Mae, ticker symbol FNMA, Economic and Strategic Research Group. The ESR Group projects new and existing home sales to total 4.72 million in 2025 and 5.16 million in 2026. Single-family mortgage originations actively is expected to total $1.85 trillion in 2025, $2.32 trillion in 26, with the refinance share rising from 26% in 2025 to 35% in 2026 on the lower mortgage rate outlook. So you can go out there and visit Fannie Mae's Data Insights page to read the full September 2025 Economic and Housing Outlook study, including economic developments, commentary, forecasts, and about the housing market. So the ESR Group, that is Fannie Mae's Economic and Strategic Research Group, is led by Chief Economist Mark Paleem, studies current data, analyzes historical and emerging trends, and conducts surveys of consumers and mortgage lenders to inform forecasts and analysis on the economy, housing, and mortgage markets. You can go there by going to fanniemae.com in their newsroom, and they have places to subscribe to their RSS feed. So wanted to let everybody know about that. The Mortgage News Daily. So I get this daily publication, which I find very helpful. Matthew Graham is the editor who sent this out. Got it about an hour ago. And what he said was mortgage rates began the week right in line with their highest levels of the past 30 days. This sounds a bit more dramatic than it is, because the past 2.5 weeks have been very narrow, and today's rates are merely at the upper edge of that range. For example, not much different than the recent lows. There were no meaningful economic reports driving volatility in the underlying bond market. Bonds dictate rates, as you know, so mortgage-backed securities and things like that. But overseas developments caused broad bond market weakness overnight. Weaker bonds equals higher rates, all else equal. More extreme rate movement remains on hold until the government shutdown ends, thus allowing the publication of the big ticket economic reports that have been the biggest impacts on interest rates, as well as the Fed raising or lowering rates and having guidance around that. So they got a chart up here. I pulled it from Wide Charts, but the 30-year fixed rate is at 6.38%, 15-year fixed 5.9%, 30-year FHA 6.07%, 30-year jumbo 6.28%, the 7 or 6 SOFR is at 5.84%, and then the 30-year VA is at 6.09%. So just following and looking at the mortgage-backed market, the 10-year Treasury is at 4.158, as I mentioned before, and we'll be tracking this type of stuff and trying to give some mortgage rate updates here and there as we go through the Northbound Wealth Podcast. So the 2025 Guide to Protecting Seniors from Fraud. I posted this on my blog on October 1st. If you found yourself stepping into a more active role in your parents' financial lives, you're not alone. Some of us are helping aging parents navigate everything from healthcare decisions to bill payments, and increasingly, we're also the first in line of defense against financial scams. Fraudsters are getting more sophisticated, and unfortunately, older adults are being targeted more than ever. Whether it's phishing texts, fake tech support calls, or convincing looking emails. These scams are designed to exploit trust, isolation, and confusion. And they're working. According to the Federal Bureau of Investigation, or FBI, losses among older Americans are rising fast. That's why we've pulled together some of the practical steps you can take now to help protect the older adults in your life. While we're not cybersecurity experts, we believe understanding these threats is part of protecting the people and personal finances that matter most. In this segment, we will outline what to watch for and how to help your family and friends feel more confident in spotting red flags before it's too late. So, first of all, how big is the problem? In 2024, consumers lost more than $1 trillion to scams worldwide, according to the Global Anti-Scam Alliance. Over half of all consumers reported encountering fraudsters at least once a week. A recent study found that 2 out of 5 seniors over the age of 60 have fallen victim to some scam, while 37% of seniors were victims, 73% reporting knowing someone who was. Of those scammed, 49% reported losing money. The average amount lost was $3,590. Identity theft involving sensitive, personally identifiable information such as social security numbers can have long-lasting effects. Thieves may wait months or even years to use information, or they might sell it on the dark web, requiring you to stay vigilant indefinitely. Legal fees and other costs could add to the financial impact if the identity theft issue is complex. Some victims even need to seek government assistance during recovery, highlighting the potential magnitude of identity theft hardships. While there may be some considerable inconvenience and real financial ramifications to fraud, there's also a psychological impact, including the feelings of shame, safety concerns, and worries about lost independence. What scams are working the best? Some of the scams senior citizens have fallen victim to include online shopping scams, tech support scams, phishing scams, internet fraud, and identity theft. So the top ones, online shopping scams occurs when cyber criminals portray themselves online as legitimate sellers of services or merchandise to steal personal information or money. They create fake websites that look genuine or impersonate legitimate retailers. Other cyber criminals will create fake accounts on well-established online marketplaces and sell items that are too good to be true. Consider the following information. Avoid clicking on suspicious links from unsolicited messages or questionable social media ads. To be careful, type in the URL instead of clicking on search results or unsolicited messages. Use a credit card over a debit card because credit cards are more secure and may provide better fraud protection if a scam occurs. Only shop on reputable websites, avoiding sites with discrepancies, poor reviews, and unrealistic offers. Help manage financial accounts by using strong and unique passwords for each, enabling multi-factor authentication, or MFA, setting up financial alerts, and creating accounts with reputable retailers. Number 2, tech support scams can begin with a pop-up message featuring a logo from a well-known tech company claiming your computer is a virus and instructing you to click or call a supposed support number. Criminals request remote access to your computer where they can access all of your data and install malware. These scammers may also try to sell useless software maintenance or warranty programs. AARP notes that consumers age 60 and older are 5 times more likely than their younger counterparts to lose money to tech support scams, which cost older Americans more than $175 million in 2023, the Federal Trade Commission reported in October of 2024. Remember that the legitimate technology providers don't call, email, or text about computer problems and won't ask you to make a call or click on this link. The FTC states that if a supposed tech support person calls unexpectedly, be skeptical. So, if this should happen, hang up the phone, avoid clicking on pop-ups, refuse remote access, and never, ever share your password. Number 3, phishing scams are broad. It's a broad term for cyber crimes in which targets are contacted by email, telephone, or text by someone posing as a legitimate person or institution. I've had this happen to me, like a toll booth in a state I've never been in. even in years, was sending me saying I needed to pay this toll. Another one was the IRS. I owed them money, and so they were texting me saying I owed them money. It's just crazy, the scams that are out there. Victims are then lured into providing sensitive data such as identity details, banking and credit card numbers, and passwords. So just delete that stuff. Don't even look at it. The the information is then used to access accounts and can result in identity theft and financial loss. I just thought of another one. We signed up for a trash service recently, and now I get these text messages and phone calls saying that they'll report me to collections if I don't pay. And that one is just ridiculous. I just keep deleting and blocking that number, but it keeps changing. It's interesting too. So while phishing can be targeted at anyone, seniors should be on the lookout for some specific elderly scams, including the following: Medicare health insurance scams. So fraudsters in these pose as Medicare representatives to steal personal information or offer fake services. Don't give out your Medicare numbers to anyone suspicious, and never pay for services not received. Grandparent scams. So in these, a caller pretends to be a grandchild in trouble, for example, in jail or injured, and asks you to send money urgently. The criminal will usually insist on secrecy and ask for a wire transfer or gift cards. Sweepstakes or lottery scams. Individuals are contacted in these scams and informed that they have won a prize, but must pay fees up front to claim it. Again, hang up the phone, disregard the letter, and delete the email. IRS or government impersonation scams. Some scammers attempt to intimidate older individuals by pretending to be from the IRS or other government agencies and demanding immediate payment, threatening jail time if the payment isn't made. Know that the government will never use high-pressure tactics and threats over the phone or by email. Charity scams. So fake charities, this one's prevalent. They can deceive people by soliciting donations. This can happen especially after highly publicized natural disasters. Caution your family to stick with charities they know and trust and avoid those that have vague missions, pressure them to donate immediately, or refuse to provide documentation. Financial services scams. These scammers use various methods, including calls, texts, and email messages to impersonate legitimate banks, mortgage companies, or debt collectors. They may claim that a checking or savings account has been compromised and ask for personal information, such as passwords or social security numbers, to resolve the issue. They may even threaten arrest for unpaid bills. Ignore those. Those are threats. It's terrible. Report them to state regulatory or federal agencies, and so that those people can be investigated. So, technology and artificial intelligence is making scamming easier. So I'm going to talk about that. So, technology has made scams more commonplace, enabling fraudsters to create increasingly sophisticated digital scams. Bad actors don't even need to be tech professionals to develop large-scale cyber fraud operations. Innovative tools can be used to easily generate millions of highly convincing emails, text messages, and websites that can successfully trick even the most careful individuals. If they can fool the digital natives out there, think what they can pull on your family. So, artificial intelligence scams are on the rise, with AI-enabled tools capable of targeting consumers in highly sophisticated and personalized ways. Some of the latest AI scams include voice cloning, deep fake scams, and phishing email attacks. Unlike traditional scams, which employ more generic tactics, AI enables criminals to create websites, emails, and impersonations that appear, feel, and sound incredibly authentic and believable. Leveraging AI, scammers can quickly, easily, and cheaply launch large-scale fraud campaigns or target specific people using information gathered from social media or other platforms. The FBI has warned that AI scams are on the rise, saying, as technology continues to evolve, so do cyber criminals' tactics. Here are a few of the latest AI scams. Voice cloning. So AI can be used to clone a person's voice using just a short audio sample. Voice cloning is often used in scams where the fraudster impersonates a family member in trouble or financial distress who urgently needs money sent to them. As you can imagine, this can be especially effective on older adults. Deepfake scams. So deepfake technology utilizes AI to create realistic videos, photos, and audio clips that appear to depict someone saying or doing something they didn't. This technology is being used to impersonate public figures or celebrities and promote fraudulent products or persuade consumers to take specific actions. Deepfakes are becoming increasingly sophisticated, exacerbating this growing problem throughout society. And I think Joe Rogan had that happen. I think a few other big time people and celebrities had that happen on like Facebook and other places. Phishing email attacks. So while phishing emails aims to steal personal information have been around for a while, AI has allowed crooks to ramp up the deception. An article from the May 2024 issue of the Harvard Business Review says, quote, with AI, scammers can generate very authentic phishing emails that bypass spam filters. These emails often appear to be genuine account notifications or urgent requests from reputable companies. What's more, their content is often very personalized. So, pay attention, be awake. Many scams go unreported. Many people don't report scams, making these crimes hard to prosecute, even harder to get reliable statistics. Elderly victims may also be too embarrassed to admit that they were taken advantage of, even to family members. Others don't know where to turn or what to do to report the crime. The bad guys know this and consider elderly people low risk. By discussing risks of scams with your family, you can remove the stigma and equip them with tools to better manage cyber threats. Actions to protect your family. You can take several steps to help your family manage attempted scams. Some involve technology, while others are low tech and require a conversation and perhaps a slight adjustment in habits. So make sure they know to confirm any request or message before acting, especially if it's unexpected or unusual. If someone claims to be a relative or authority figure looking for immediate cash, have them call you or another trusted source who can confirm if it's a legitimate request. An effective way to avoid theft is to have your family create different passwords for their accounts and change them frequently. Many people use the same password for multiple accounts and fail to update it, which can be problematic. Install trusted security technology on your family's devices, such as antivirus software or other tools that help protect against phishing scams, deepfakes, and spam text messages. Other options include password managers, identity theft protection, virtual personal networks, and two-factor authentication on devices and accounts. Caution your family about sharing too many personal details online. Scammers can use any information you provide to personalize their attacks. Review your credit card and bank statements to spot any suspicious activity. Consider freezing all of your family's credit files so no one can look at or request their credit report. Open an account, apply for a loan, or get a new credit card while their credit is frozen. Another way to protect against scams is to register your family's numbers on the National Do Not Call Registry. This should decrease the unsolicited calls they receive, potentially lowering the risk of falling victim to phone scams. Your bank accounts should have automatic fraud prevention and detection tools to alert you if they identify a fraud attempt. Online banking notifications are one of the fastest ways to receive these alerts. If your family hasn't already, you can help them set up their online bank accounts. Consider adding a trusted contact to your family's investment accounts. This is a person whom the financial institution is authorized to contact if there is a concern about fraudulent activity in the account. A trusted contact may be a family member or another trusted third party. A trusted contact provides an additional layer of safety on your family's accounts and puts your financial firm in a better position to help manage your accounts. We are here for you, so by implementing these preventative measures and staying vigilant, you can help your family manage the risk of becoming a victim of increasingly sophisticated and persistent criminals. If you have any additional questions or concerns, please do not hesitate to reach out to Northbound Wealth Management. My name is Brent Foster, the CEO of Northbound Wealth, and your host of the Northbound Wealth Podcast, 317-399-1107. Thanks for listening and have a great week and weekend.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.